Retail giant Walmart recently warned that price increases related to tariffs are imminent, saying that you've not already seen prices rising, it will happen in May and then become more pronounced thereafter.
The level of tariffs that have been proposed is pretty challenging for all retailers, for suppliers, and certainly our concern is that consumers are going to feel some of that. So we're going to keep prices as low as we can for as long as we can for our customers and members.
So the question becomes, how high could inflation go, and how long will that high level inflation last, and what ultimately does it mean for your money? Well, so predicting how much inflation will rise in response to tariffs is definitely tricky because there are so many variables, most obvious of which is just exactly what the tariff rate is still a moving target. I'm recording this on May 16th, and just a week ago, it looked like tariffs from China were going to be 145%, and now it looks like more like 30%, with actually a number of goods kind of carved out from tariffs, getting something more generous. So that certainly makes a big difference in trying to calculate what the inflation rate is going to be. And so other trade deals could be reached. We know that one deal was already done with the UK. The White House has told us that other deals are imminent. On the flip side, Trump could certainly unpause certain tariffs. Remember that currently we're on a 90-day pause from the tariffs that were announced on Liberation Day. In theory, I don't think this is going to happen, but in theory, he could unpause them, maybe even just on some countries, in which case it would effectively be like tariffs re-raising again. So these are all major unknowns. We don't know what's going to happen with the tariff rate. We also don't know exactly how companies or consumers are going to react to tariff effects. So let's dig into what all this is and how this could impact things like interest rates, the stock market, or the Fed. So first, it's probably true that most of the inflationary effects of tariffs will be felt in a short burst, probably over the next 2 or 3 months. And this is because the cost of tariffs to companies are going to occur more or less immediately. And so if they're going to pass through that cost to consumers, they're probably going to do it more or less immediately. So one estimate comes from the Yale Budget Lab. They've been doing a pretty good job tracking the different changes in tariffs kind of as they're happening real time. So as of yesterday, I'm recording this May 16th. So as of May 15th, they estimated that tariffs would cause something like a 1.4% increase in prices over some short period of time. So if we use that estimate as a baseline, and if we assume that that 1.4% increase occurs over a 2 or 3 month period, that would imply that core inflation peaks around 4% on a 12-month basis, sometime in June or July. Now note, when we're using this price spike of 1.4%, we're talking about the average price of everything. That doesn't mean that every good is going to rise by 1.4%. Remember that only about 1/3 of consumer spending is on physical goods, the kind that usually are trade across borders and therefore impacted by tariffs. The rest of it's on services, which mostly aren't impacted by tariffs. And so really what we'd expect is a much larger increase of the price of goods, and maybe some goods increase by a very large amount, while others increase by a small amount. Maybe services don't increase by much at all. The average comes out to something like a 1.4% short-term spike. Now, this estimate makes a lot of big assumptions, and if any of those assumptions aren't quite right, inflation could be significantly higher or significantly lower. One of those assumptions is just that tariffs don't change in a major way going forward. In other words, that whatever deals the Trump White House negotiates with trading partners are roughly similar to the current paused tariff world. That's not a terrible assumption, given that the one deal that was negotiated with the UK is pretty close to the tariff pause. There was only a few goods sort of carved out, and the rest of goods are subject to a 10% tariff. So I think it's a reasonable assumption. China is a bit more of a variable, but I don't think Chinese tariffs are going to go to zero. And so we sort of assume that China tariffs are going to be somewhere in the 30% neighborhood for most goods. Maybe some goods get lower. Then we're kind of in the ballpark of what the assumptions are behind the Yale project's estimate. But we also don't know how much companies are going to choose to raise prices, right? So on one hand, some companies may decide to not hike prices by the full amount of the tariff because they're worried about losing sales. On the other hand, we could see companies hiking prices who aren't even impacted by tariffs at all, right? So maybe I have a Chinese competitor that's raising their prices, and I think, well, even though I'm a domestic producer, I can get away with raising prices too, make higher profits. Like, companies are definitely going to do things like that if they think they can. And so this makes for a lot of variables, making a precise forecast very difficult. I do think that 1.4% estimate for the initial spike is pretty reasonable. It's in the right ballpark, but there's plenty of room for inflation to wind up being higher or lower. Now, after this initial spike, what happens next? So a lot's going to depend on what's happening in the economy at that point, right? So remember that in order to get sustained inflation, that is where prices keep rising at a high rate month after month after month after month, you need consumer spending to also be pretty strong and probably increase kind of in conjunction with inflation. And generally, that requires wages to be growing rapidly. Basically, consumers can't keep growing their spending month after month after month in a rapid fashion if they don't have more income with which to spend. So this is exactly what we saw when inflation was high in 2021 and 2022. That high inflation coincided with high wage growth. So real reason to think tariffs would cause rapid wage growth. If anything, I think we could see the opposite. There's broad agreement among economists that tariffs will cause some degree of economic weakness and probably an increase in unemployment. And when unemployment is rising, usually consumers aren't spending more, they're spending less. And so that would typically cause inflation to slow down if, in fact, the economy is getting weaker. So I would expect that after a short period of rapid price increases, the rate of inflation subsides. Now, to be clear, what I mean by that is not that prices fall, but rather the rate of price increases slows. Exactly how much it slows depends on how weak the economy is at that moment. So if we assume that economic growth kind of settles in roughly where it is now, then I'd expect the rate of inflation to settle in roughly where it is now. It's kind of the mid to low 2% area. Whereas if the U.S. falls all the way into a recession, I'd expect inflation to drop a lot more than that. When it comes to the stock market, remember that it's all about whether companies can maintain profit growth or not. And that probably comes down to how well the economy holds up in the face of tariffs. So if tariffs drive the U.S. into a full-blown recession, then stocks pretty likely to suffer, in my opinion. But if the economy shakes off any tariff impact completely, keep growing at a similar pace as we did, say, in 2024, I'd expect stocks to rise, probably by a good bit. But there's a good chance the reality is somewhere in between, that the economy weakens by some degree, but maybe not all the way to a recession. In that scenario, the Federal Reserve probably becomes really key. Now, the Fed is in a tricky position. We could be experiencing, especially over the summer, a period of rising inflation and rising unemployment at the same time. That's something called stagflation. We did a video on stagflation earlier, so check that out if you want more detail about that situation. However, if the economy does slow kind of toward the back half of this year, then the Fed is going to be able to safely assume that inflation is subsiding. So I expect that in that scenario, they'll be comfortable cutting rates. Fed Chair Jerome Pal recently talked about exactly this situation. He said, talk about what they would do if their two mandates, inflation and employment were in tension, is the word he used. And he said they would determine if either of those variables were likely to kind of self-correct. And if so, how quickly that could happen. So reading between the lines of what Powell is telling us, it's pretty obvious to me that it's much more likely that inflation sort of self-corrects in a relatively short period of time compared with unemployment. As we said before, most of the price impact of tariffs is probably felt in one short burst. And after that, it's probably likely that the rate of inflation slows. And so the Fed is going to see this same thing. They're going to say, well, I know inflation's high right this moment, but that's kind of due to this one-time factor. We can see inflation already subsiding. They're going to wait a couple months to prove that, but they'll see it happening relatively rapidly, most likely. Whereas the unemployment effect probably is only building over the summer, and we'll see unemployment rising if, in fact, the economy is weakening. And so I think it'll be pretty easy for the Fed to conclude that economic weakness problem is lasting, that inflation problem is probably going to solve itself. So given the logic that the Fed chair has given us, it seems clear to me that if the economy is showing signs of significant weakness, then rate cuts are soon to follow. So putting all this together, I definitely think tariffs are likely to cause prices to rise. So a lot of the goods you and I buy are going to get more expensive. For investors, though, the outlook is a bit more hopeful. Certainly, there's a good possibility that the economy weakens by some degree in response to tariffs, but it may not be enough to push the U.S. into recession. It may actually be that if the Fed can manage to cut rates in time, which we think is likely, that could boost the economy and or the stock market. And so either of these two scenarios are pretty good for stock investors. But hey, what do you think? What do you think that impact of rising prices will be on consumer confidence or on business planning? Love to hear your thoughts. Put a comment in the comment section. I'm happy to respond to anything I see there myself. If you like this content, you want to hear more about what's coming on inflation or policy out of the White House or the Fed or markets or what have you, hit that subscribe button. We're going to be coming at you about once a week with new content. I'd love to see you again.